Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about STEM in an earnings preview as they are announcing earnings this Thursday, May 4th, after hours. Something that I would note is since the last time we did one of these videos, the stock has gone down quite a bit. The last trade after close was at $3.78 at the time of making this video. That is significantly lower than our last earnings calculation. If we look at the charts available here, you'll note in the calculation the last earnings time frame, the stock was above $10 a share. So we've seen a 70% reduction since the last earnings to a new all-time low here at $3.78. The reason that I highlight that is because there is a significant move away from risk-on assets, especially non-profitable tech. So the question is going to be, how can we value or evaluate STEM at this point in time as they go into earnings, and what should we be looking for? First off, I would highlight that if you are a shareholder, you should have received from your brokerage the capability to vote on a number of items at this point in time. My recommendation is that you do have the capability to make your voice heard, and I would recommend that you take a look at those action items and vote accordingly. At this point in time, I'd like to see a number of inputs from management to put STEM on the right track from a stock perspective. I think earnings could get very, very ugly this quarter depending on kind of expectations and where we could see the company go from here. At this point in time, the consensus estimates are going to be available here in Q1, with the estimate going to be right at negative 24 cents a share. It's important to note that as of right now, STEM is projecting that they should be EBITDA positive on the latter half of this calendar year, with the approach or expectation that they will be net income positive on a GAAP basis in 2024. For them to be able to do that, if we look at the fundamentals available for the company and we hop into income statement at this point in time, you'll note that again, the net income has been a widening loss over the course of the past 4 quarters, despite the fact that revenue has been ramping up incrementally. At this point in time, we will showcase the expected revenues for this company, but you can see that Q1 historically has always been the slow quarter. However, last year they had a rampant success in terms of growing revenue. Unfortunately, this came at the cost of large increases in that cost of revenue, or cost of goods sold is the major component of that. You can see that they look to be managing the sales expense associated with the company pretty well as R&D. I'm looking forward to seeing what their feedback is going to be in regards to AI development, just due to the fact that everything for a number of the largest companies has been really focused on AI. And STEM historically has touted their AI model. At this point in time, that's going to be largely algorithm-based. I would be interested in seeing if they're able to employ things like ChatGPT or other research networks to be able to leverage the sheer amount of data that they are collecting, as that is going to be larger than a lot of the other players in the space. And if it's not the largest, it is still going to be very material. So it's important to note that with all of this information, they did do a raise via debt for their cash balances. As of Q4, what I'm going to be looking for, as of Q4, they had cash and short-term investments here of $250 million. That was a decline from the $294 million that they had in the prior period. I will be looking at this number on a go-forward basis, recognizing that they did raise some additional debt, and they had the calculation, or rather they paid off other debt with this new debt. This new debt is at a higher rate. I'd like to see some of the commentary associated with this transaction, see what that puts them from a cash perspective. All of this points to, again, strong from a cash proponent right here. However, I will be looking at the cash flows that we should be able to see here on this screen, and you can see total cash from operations was negative $106 million. So that could be very worrisome if this trend were to continue. Now, recognizing that a lot of this at this point in time is still in the accounts receivable, I expect that their cash balance should look better than I would expect on a go-forward basis. Now, it'll be interesting to watch based off of forward-looking expectations. But as of right now, the company overall is going to be highly focused on a few different metrics. One being top line revenue growth on a quarterly basis and a trailing 12 months basis, or annual year over year. The reason why I want to highlight revenue is Q4 is always their big quarter. I do expect Q1 of this year to be quite a bit lower. However, we need it to be higher than what it was last Q1, which was $45 million. In addition to this, I would highlight from a profitability perspective that their gross profit margin has to be higher. We'll talk about that a little bit more here momentarily. But the net profit margin, we've got to get this into the low double digits, if not single digits, for them to be able to really make a dent and change people's opinions about the company. Last but not least, from a valuation perspective, because they are not profitable, price to earnings is not going to be the best metric. Price to sales, they are significantly lower than the industry average. Even kind of in the utility space, you would expect this to be around 3x. So we are quite low compared to the broader industry. So therefore what? Let's take a look at the earnings presentation from Q1 and what we should be looking at and forecasting for the Q1 calculation, or rather the Q1 earnings call. So what I'm showcasing here on the screen is the 2023 guidance. This is showcasing total revenue numbers. At the low end for 2023, that would be $550 million. That would have the 10% estimate that you see here is going to be right at $55 million. This is compared to Q1 of last year of $45 million. I'd really like this to come in on the upper side of guidance, especially if they could beat that, if they're above $65 million and they're growing bookings. I think that could point to a strong year. We've got to see some level of good news if we are expecting to see any type of movement. I did check their LinkedIn page earlier today, and I would highlight that the company continues to be hiring. They continue to be growing. For all intents and purposes, they're not on a freeze or anything. So I do think that from a growth perspective, they're actively looking to grow the overall top line numbers here. That's going to continue to be a focus. However, we also need to note that they need to grow in a profitable manner. Now, one of the things they're looking to do down below is highlight that most of their backlog in 2022 was higher gross margin, and I expect that to increase in 2023. And the expectation is that's going to be what really drives profitability, primarily if the CARR, contracted annual recurring revenue, is going to be primarily software in nature. Right now, it seems to be mostly professional services. We need that to be that Athena AI platform, especially if they can target a large increase in these numbers today. At this point in time, if we come up above into some of the CAR metrics that they've currently got in the platform, you can see that that is currently at 65 million. So again, that was that 7% quarter over quarter for Q4. And at this point in time, they are forecasting that to grow all the way to 80 to 90 million. Again, that is not a very high conversion rate between the numbers you see here into contractual annual recurring revenue. However, if they can be at around $100 million at the end of this year, I would expect that to look very, very nice for the company overall. That recurring revenue is how companies will continue to be valued. So therefore what? In addition to that information available there, I still expect there, from a cost savings perspective, people are always going to be looking for these storage solution or energy efficient solutions, but also STEM is going to continue to expand into the dealer network or the energy network for charging stations. And I think that there's going to continue to be very high margin business opportunities there. The question is really going to be, how are they going to be able to scale that and do so profitably? So it's important to note that the things I'm going to look for on a go-forward basis, obviously those revenues super important. We've got to see growth in CAR. And in addition to that, I'm not worried about this adjusted EBITDA number. I think that's great, but I'm going to look at those cash balances as well as how much they're keeping after they go through their expense accounts. I think those metrics right there are going to be what's going to be the capability to drive the company upward. I could very easily see a 10% move either direction from this earnings report. 10% down, there's not a lot of move. 10% up really is only going to put the company right at about $4 to $4 a share, $4.10 a share. That's still pretty worrisome to me. And I'm not further investing or buying at this time, just because, again, when you're left holding the bag, you don't necessarily want to continue to hold it. And I do think that if the company regains or starts pointing in alignment with its prior guidance that it's going to be profitable next year, that those shares will recover. I think that it's going to do very well should that happen. But it's kind of one of those situations where it's a fool me once, shame on me, fool me twice, shame on you. And at this point in time, we've seen a number of backtracking on some of the original estimates. Overall, they're still in line with the majority of those estimates, but I feel like the rug's been pulled a number of times, and I'd like to see them hit some of these numbers and exceed some of these numbers, despite the fact that it's not the most business-friendly environment at this point in time. They have a significant backlog. They should be able to translate a lot of that into revenue, and hopefully translate a lot of that revenue into recurring revenue. But that's what we're going to be watching for this earnings. So let me know in the comment section down below your thoughts. I know it's been a painful past 3 months, but interested in hearing from you and interested in seeing the call later this week. Thanks for watching if you made it this far, and we'll talk with you later.